Hey, good morning, everybody. It is Thursday morning. It's Thursday morning live. You know what time it is. Buckle up, right? Grab your coffee, sit back, just take the next few minutes. You're in for a treat. I have a local Chicago guy on, Juan Hernandez, a CPA out of Schaumburg that I've had the opportunity to meet and start to build a relationship with. And I think you guys are going to love Juan this morning. He's been an accountant for 15 years. And he just made a comment to me. He says he wrestles tigers. So I'm looking forward to hearing more about wrestling tigers this morning. And we're going to talk about some tax saving strategies. There's some new things that have come up, and we're going to take a look at how, as a business owner, you can save on some taxes. So, hey, good morning. Please drop any comments or thoughts, questions in the comments this morning. We'll get those answered for you as we go along this morning. Say hi. Let us know where you're from. Hey, Melissa, good to see you this morning. Please drop your name and where you're from in the chat. Let us know who's here. And I want to just start this morning, typical, like I usually start, right? Intentions, right? What are your intentions? How did you get up this morning? What was your daily routine? What did you work through? Did you pray? Did you meditate? Did you exercise? Did you take a look at your day and map it out, plan it out, time block the important things that need to be done? Hey, you know what? It's the time of year. People always ask me, they say, when do you start planning for the next year? And I always tend to start October, November, this time of year. I like to take my calendar and start to block those things out like family vacations, trips, going away, business trips, when maybe I'll be going to a seminar or an event, speaking somewhere, where those types of things go in there first. And then we build the rest of the work day or the work week around that. So, I try to be very intentional about the time I spent and the things that we do. And I think we all need to be that way. I know this morning our guest is pretty intentional about what he does and how he helps his clients. So please, one thing, like us, like this, share this video. If you're watching on YouTube or Facebook, or you're out on LinkedIn, please like us, share it. And if you're on YouTube, subscribe to the channel, because we're always bringing relevant content. So let's bring Juan in. Hey, Juan, good morning.
Good morning, Mike.
Good to see you. Yeah, how you been?
Excellent.
You and I actually, I think, I'm not sure if we met at a Windy City event or if we met at the GOB conference, but we've run into each other a few times now, gotten to know each other a little bit. And I love your comment that you wrestle tigers.
Yeah, you kind of have to in my industry, on both sides, on the client side and on the government side. So.
Yeah. Hey, so I always start my shows one question, and here's the funny thing, right? Is one of these days I'm going to write a book. I'm going to take all of these one-word answers that people have said, and I'm going to write a book and a little bit about the conversation with them. But in one word, what best describes you personally and professionally?
I think I'm just effective at what I do. I wake up every morning and I wake up terrified, to be honest, because I know that if I don't give this 110%, I might lose a client. So, I wake up every morning terrified, thinking about that. And I roll out the red carpet for everybody, small or big.
Yeah. Excellent. So, well, let's start here. Tell us a little bit about your background. How you
absolutely.
got into accounting and.
Yeah, for sure. So I've been in practice for about 15 years. I've had the fortune of having a bit of a more diversified experience than most CPAs. I've worked at early on in my career. Started out at small firms. Started at a firm that was 4 people. Then later, worked at a firm that was about 60 people. The last firm I worked at was Cohn Resnick, national 3,000 people. I had the fortune of working in their real estate group. So, the last 3-4 years of my career have been 100% dedicated to real estate. I worked in the low income housing, with low income housing tax credits, all those tax incentivized deals, new market tax credits, historic tax credits, and also a lot of commercial real estate. So, I wasn't at the beginning of my career at Cohn Resnick, I wasn't entirely sure that I was going to like real estate, but after a while, I ended up falling in love with it, and now I won't do anything else. So when I decided to pursue my dream and start my own firm, I decided to, not be a generalist and, dedicate my practice entirely to real estate. And I'm very happy that I did that.
Nice. So what do you think the shift was that you like real estate today where you didn't think you were going to like it before?
I think it was more of an education. I didn't know much about it. I didn't know anything about the industry. I didn't know what the tax incentives were. I think right about when I started, or maybe a little bit after, we had come off the real estate crisis with the mortgages ballooning up and people losing their homes. I think we've had that a couple of times in my lifetime. And so I had a bad, I had a bad connotation about the industry, and I was worried that if that happened again, I was going to be out of a job. So it was more of a job security concern, but after knowing what I know today about the industry, it is absolutely not a concern anymore.
Nice.
There's absolute job security here.
Yeah. Yeah, well, that's for sure, right? I mean, I was at a networking event last night and talking to a guy next to me, and he said, "Yeah, you should just buy land." I said, "Yeah, God's not making any more land, and it. So there's going to always be some type of some form of real estate, whether it's just dirt or whether there's a building on that dirt, right?"
Absolutely.
Here, you said something interesting, and I kind of want to circle back to this because I'm a very, in my buy box, when I look to buy apartment buildings, apartment complexes, in my buy box, I'm a pretty straightforward market rate rent, workforce housing, B-class product, garden style. But you mentioned low income housing tax credits. Talk about that a little bit and why there's some advantages to that for the real estate investor, or we'll just talk about some of those advantages.
Yeah, absolutely. So the low-income housing tax credits were initially implemented by the Community Reinvestment Act. This was a long time ago, and
87, right?
Yeah, something like that. It was, probably around the time I was born, to be honest.
Yeah. Wasn't it? Didn't it happen right around the time the resolution trust thing?
Yes.
Yeah.
Yes. So these credits are there. It's a government incentive to really incentivize investors to invest in low-income housing communities. It's also a way to re-gentrify neighborhoods. But most of the guys that are investing in these deals, to be honest, it's all institutional money. What the Community Reinvestment Act mandates is, if you're a bank, you have to invest a certain percentage of your earnings into the community. And so this is the way that the banks meet that requirement, if you will, by investing in low-income housing projects. The economics are like anything I've ever seen before. I mean, they are like you're on a different planet, on the developer and on the investor side. So your typical, commercial real estate deal economics are just not going to work in a low-income housing deal because they're not meant to make money, if that makes sense.
Yeah.
So yeah. I can talk about this all day if you want me to, but I'm not sure how much time we got.
Yeah. We we go for about 15-20 minutes on Thursday Morning Live. So let me real quick just say hi to Lilia from Delray Beach, Florida. So It's nice to see that we have a little bit of bandwidth this morning and some other people chiming in. I know Melissa's from one of the coast sides too. So, but hey, there's a bunch of people on this morning. If you want to make a comment, drop your name in the chat, say hello. Be good to hear from who's here this morning and where you're from. If you have questions for Juan, let us know. Juan, let's talk about some tax savings. Now, I would think that most real estate investors know about the word depreciation. They know what it is, what it'll do for people. But beyond depreciation, let's talk about some other tax saving benefits that real estate offers for the investor.
Yeah, absolutely. So, this kind of segues into a little bit of what I said earlier. The reason I fell in love with real estate and why I enjoy working in this industry so much is you have tools available to you in terms of tax savings that you just don't have in other industries, and I just want to bring that front and center because, if you're in the widget manufacturing industry, you don't have a lot of those tools available that a real estate investor is going to have. If you're a real estate investor, you can really, if you execute a tax plan, you can get to zero tax. It is entirely possible. Whereas the widget manufacturer, much more difficult to do that. But to speak specifically to tax savings, one of them is depreciation. So cost segregation studies, which get you accelerated depreciation under the TCJA rules of 2017. Anything that the IRS classifies as 20-year property or less, 15-year, 5-year property is eligible for 100% bonus. So what does that mean? That means that you get an immediate write-off on anything such as land improvement is a 15-year property. So the parking lots, the fencing, the landscaping, light post, maybe signs that are on the land and not attached to the building. That's all 15-year property. A cost segregation study will go in, identify that property, segregate it so that you can take advantage of that 100% bonus depreciation. Another comment about bonus, the way the tax law is written now, it goes down by 20% starting next year. So next year it'll be 80%, and then it goes down 20% for the next 5 years until it reaches 0%. So anybody that has an acquisition in 2022 after 2017, you're eligible for 100% bonus depreciation. You don't have to do the cost seg this year. You just have to do it before you file your tax return. So, there's a lot of information there, but I think in general that's sort of the gist of it. I think beyond that, there's energy efficiency incentives such as 179D. I'll kind of explain what that is. So I have a client who is in the pallet business, and she purchased. The reason I got involved is because she purchased a 60,000 square foot warehouse to house her business, and so one of the things that we're doing is we're doing a 179D study in conjunction with one of my partners. And what that gets you is there's up to $1.80 deduction per square foot. Now, if you're talking about a 60,000 square foot facility, that equates to roughly $108,000 of a free deduction. And the way that you get the deduction is by meeting certain efficiency standards. It's 50% based on engineering standards for your mechanical. So it's mechanical, the lighting has to be LED lighting, and the shell of the building. So it's a 3-part test. Each one contributes to that deduction, and the maximum is $1.80 per square foot. That amount is going to change going into next year. We don't know what it is yet, but as of 2022, it's $1.80. Beyond that, some things that I think the majority of people don't know that are part of that, TCJA. I know, we kind of keep going back, but the tax law drastically changed. I don't know that many people realize just how much it changed in 2017. I mean, it basically tripled the time that a preparer spent on a return. That's how complicated they made it, But, one of the things that they did that is specific to real estate and that I think is good is, they did allow roofs to be Section 179, which means that, so Section 179 is, this is not 179D, that's the one I just talked about. This is regular 179. And what that allows to do is you get an immediate write-off for any roof improvement on a building. So, if you're buying a resident, it doesn't matter what kind of building, commercial, residential, industrial, you put a new roof on, you get an immediate write-off. There is a limitation up to $1 million, which is pretty high. I think most real estate investors will be able to take advantage of it. And, there's some other nuances related to limiting the amount of deduction you can take. But in general, it's a pretty good incentive.
Yeah.
Most people are unaware.
Let me hang on. I have a couple of questions. So,
Sure.
So we did a cost seg study on a property that we own in Tampa, and it's done, it's finished. We've done our taxes for 2021, but the hurricane came through, knocked a tree down, knocked a corner of a roof off. We needed to put a new roof on, rebuild all that. So that repair can that be, do we add that to the cost seg, or is it just dollar for dollar against the property expenses, or added on to the property expenses?
Yeah, no, that's a really great question. That's a good opportunity to get some tax deductions for sure. There's two things you can do with this. One is you can do a PAT study, and you can do the Section 179. So the Section 179, you don't need an engineer to go out to the building. You don't need a study. You just basically, at the time you're getting your tax return done for 2022, you need to let your accountant know, hey, I put a new roof on. That should be eligible for 179. I want to take a full write-off on that. So 179 is an elective code section. You have to elect into it. You don't get it automatically. So you have to let your CPA know that you want to elect into it. So that's number one. Number two is.
So hang on. So I just want to get clear on this, because do I have to go back and do an amended return for last year, or can I carry that forward and claim it? If I expensed it in 22, when I do my 22 taxes in 23, I can take it then?
Yeah, it's when you deduct it is when you did the repair.
Okay, got it. Okay.
So if it happened in 22, you do it on your 22 return.
Okay, let's back up to the bonus depreciation for a minute, okay? It's supposed to go down every year for the next 5 years to zero. Do you think that it's going to get to zero, or do you think that there'll be some changes in the law again to bring it back?
For as long as I've been practicing, there has never been bonus depreciation that is zero. So my personal take on this is that, at some point in the next 5 years, during the lame duck session, of course, is how this always happens. Congress will get together, write a bill, and extend the bonus depreciation benefit. They might even do it before it hits, maybe right around when it hits 40%. It's been, bonus depreciation has been, the lowest that I've seen is 50%. So it has never dipped below 50% in the years that I've practiced. I don't think that Congress will allow it. There's too many people that rely on that incentive, as part of their business, and I don't think Congress will allow them to lose out on that benefit.
Yeah. So correct me if I'm wrong. What's so huge about that is that you have the ability to take it. If it's all there this year, but you don't use it all, you could carry that loss forward. And how far can you carry a loss forward?
Yeah, that's a great question. So it really depends on the type of real estate investor that you are. So, if you're not a real estate professional, I think most real estate investors have heard that term. If you're not a real estate professional, then typically you're limited on the amount of losses you can take, because it's considered passive income or passive losses. If you don't have other passive activities with income to offset it against, then you get to carry the passive loss forward, and it's indefinitely. So, carried for as long as until you use it up. There's no limitation in the amount of years. However, if you're a real estate professional, this becomes an activity where you materially participate. Now you're eligible now you're not limited on the amount of losses that you can take, and you can offset it against any other income, passive, non-passive, your wages, really anything that's on your tax return. That's sort of the beauty of meeting those requirements.
Okay, interesting. So I know I've cut you off a couple of times. You were going to go somewhere else, so go ahead.
Yeah, no, I was. I think the second thing I was going to mention was the PAT study. Going back to the question on the roof in Tampa. So what a PAT study. So PAT stands for prior asset disposition, and this is also part of the what we call the tangible property regulations, which came out. I don't remember the exact year, but I think it was around 2015. And what those regulations say is that the theory behind it, think if you have a building and let's say you buy a building for $1 million today and you go in and you replace the roof immediately, you spend $100,000 on that roof. The theory is that $1 million acquisition price, part of that $1 million is there's some value associated with that old roof. And the way the IRS looks at this building is they don't look at it as one building. They look at it as a combination of assets. So every building component to them is a separate asset, the roof being a separate asset. So when you come in and you do your roof repair, replace your roof entirely, you're taking that old roof out of service, which is an independent asset, which has some value associated with it. So what the PAT study does is it identifies what that value is, and you get an immediate write-off for that old asset that you take out of service.
Interesting. Okay. So Juan, you do real estate taxes, everything from single family structures to commercial and multifamily. When you do that, do you take care of K1s? And maybe you can explain that a little bit to people. How about investors that maybe have a self-directed IRA? How do you handle those types of returns or clients actually?
Yeah, so real estate is the majority of my business. A lot of what's important to us is delivery. Especially when you get into syndications and funds. We realize that a lot of the investors in these syndications or funds are going to be passive investors. A lot of them are going to need to file by April 15. So we're very conscious about that, and we get the K1s out by 3/15, which is the filing deadline for a partnership return. In terms of the type of investor, the investor mix, whether it's a self-directed IRA, an individual, that doesn't really change anything in our process. We issue the K1 same as we would to an individual or to another type of entity, and then at the IRA level, they self-report that. But our biggest concern is timeliness. I know just for being in the industry for so long, I know that timing is a very big issue with unfortunately a lot of CPAs. And I think in real estate, it's very important because you have commitments that you made to your investors, and so part of that commitment is receiving timely K1. So that's obviously very important to us.
Interesting. So what about timelines? How about when do taxes need to be done, especially if you have a syndication and you have other investors that are involved? What are some of the timelines around it?
Yeah. So the official filing deadline, the government mandated deadline is March 15 for business returns. Any kind of business return other than a C corporation, which is due 4/15. In real estate, you don't usually see C corps because they're just not the best structure for them. But really the deadline for us is what our client tells us the deadline is. And it all depends. Sometimes you have multiple layers to go through. Maybe there's a fund that is invested in a bunch of real estate deals, so you need to get those K1. So we coordinate the work with other CPAs or other clients to make sure that we're meeting our delivery timeline to our client. But I guess to answer your question, our timeline is based on what the client needs.
Yeah, interesting. So are there timelines around K1s? Is there a date that the investor, the passive investor in a real estate deal, needs to have that K-1 in their hand?
Yeah, officially it's March 15.
Okay.
Yeah, March
Okay.
15. So when you prepare the partnership return, that's when the K1s are generated as part of the partnership return.
Okay. All right. Interesting. Any asset class that you like the best in real estate?
Any asset class, yeah, anything that's bonus eligible, I love.
Ah, that's big
Land
building.
improvements, fences, landscaping.
Yeah, but you know what's interesting is, I remember when cost seg really kind of started. There wasn't a lot of vendors out there, and now there's a ton of people that do the cost seg studies. And I was talking to somebody the other day. They even can do them on an Airbnb, which I thought was interesting. So, you know, how valuable is it on a smaller residential property versus 100-unit property?
Yeah, no, that is a phenomenal question, and I want to add something on top of that too. But let me answer your question first. So the issue is really uh, it's a concern regarding cost. You know, so cost segregations have really become a commodity over the years, and there's a lot more companies doing these things nowadays than there were 10 years ago or 15 years ago, and that's just by it's all based on obviously the availability of bonus depreciation. 100%. Over the last 5 years, it's huge. It's kind of what's driving the industry, but also technology. But in terms of a small property, so I had a prospect that approached me. He had a dental practice, and this client he had about 20 properties in Indiana. Smaller properties around 80, 90, $100,000 each. And so what we wanted to do is he was going to meet the real estate professional requirement, you know, in 2022. And what we wanted to do is we wanted to take a few of these properties, not all of them, and do cost seg so we can get him a big deduction so we can offset his dental practice income. And the problem became that, the cost segs were too expensive for the amount of benefit that he was getting out of them. I think it was somewhere around 3,500 each. So to answer your question, it's really a concern relating cost. Does it make sense? At the end of the day, what you're doing is you're buying a tax deduction, and does it make sense to pay 3,500 on a larger property? You might be paying 5,500, 10,000, $50,000 for the really big properties, but you might be getting millions in deductions. On the smaller property, it may not be worth it.
Yeah. I always say that depreciation is the only gift the government will ever give you.
Yeah, and I, if I may, I want to say something really quick about the cost segregation industry. So you really have to be careful because once all of the amateurs get in the industry, what they say, and that's what's really happening in that industry. There's a lot of guys out there doing cost segregation studies, and how do you differentiate between a good cost seg guy and a bad cost seg guy? You probably can't, but there are some things that you can look for, which I'll tell you, that will help you, hire the right guy for the job. What the main concern with the cost seg study is audits, IRS audits. So they issue you a report. Is that bulletproof? No, it never is. So
Right.
really, when the IRS comes in and audits that, they're relying on that report to either allow or disallow your deduction. And what goes into that report is very, very important. Everything behind the scenes that you don't get to see. And some of the things that the good cost seg guys do is, they will send out questionnaires to property managers. They will go in person and assess the condition of the property, take pictures. There's a lot of cost seg guys that don't even show up to see the property anymore. If your guy is one of those, you need to run really fast.
Yeah. Yeah.
So it's just a couple of things, but I think in general, if you need a recommendation on good cost seg guys, I have a couple of connections, including my old firm, Cohn Resnick, and we can definitely put you in touch with some of the good guys.
Yeah. Interesting. All right, great. Well, Juan, thanks for being here this morning. I appreciate it. Run over a
Appreciate it.
little over this morning, but I think we got started a little late. Tell people how they get a hold of you if they're looking to talk tax savings or accounting.
Yeah, absolutely. So you can reach me on my email, which I think is on the screen now. My phone number is on the screen as well. You can check out my website. It's www.hhm.cpa. There is a contact form that you can fill out, and I will, respond to you within a business day. We can have a conversation and discuss whether, we could potentially be a good fit for each other. But either one of those methods will work.
Yeah, awesome. Juan, thanks for being here. Hey, I'm going to move you out. I'm going to say goodbye to everybody and hang out with me in the back room for a minute.
Excellent. Thank you.
Yeah, you bet. Thank you. Hey, everybody. That was Thursday Morning Live. Juan Hernandez, a CPA that has some tax strategies that probably can work for anybody in the real estate space, no matter which asset class or what you're doing. So give Juan a call, reach out to him if he can be of help or answer any questions for you. I'm glad that you're here. We're here every Thursday morning. Try to focus in on the Chicago market, bring a Chicago area guest on. I was at a networking event last night, met a couple of interesting people that we're going to have on in the next few weeks. But if you know anybody from the Chicago area who's an entrepreneur, doesn't have to be strictly in the real estate space, restaurant owner, business owner that would love to be on, we always love interesting guests. So reach out to me, do a connection. I'd love to have them on. Remember, be intentional about what you do, live your life with boldness, and we'll see